Hey folks, welcome to the Real Estate Investment Network market update for June. The Fraser Valley, a little bit of the lower mainland, and I am joined by a regular guest on the show, Jordan Spitters, Eximus Realty right here in Abbotsford. Jordan, thanks for joining us.
Thanks for having me, Patrick.
So Jordan, we were talking a little bit off camera about what's going on in the Fraser Valley / lower mainland. And guess what? We kind of got sucker punched with the rate increase here recently, and you're already noticing kind of some pullback and some softening and a shift in the market. Give us a little bit of an update of what you're kind of overarching at a high level. What happened after the rate increase?
Yeah. So prior to that, detached were starting to cook along. After we'd had a couple of stable interest rate periods, things started to heat up. We were back into multiple offers on detached specifically. Attached homes, half duplexes, townhouses, condos were not really seeing that level of activity. But we were talking, 25 plus offers, 200,000, 300,000 over list price. It seemed as if we were back into, February, March of 2022. However, it was extremely short-lived. And we've got already, it was basically the night after the interest rate increase announcement came out, it was like a handbrake was pulled and detached has slowed right down. We went from having, there are still some homes that are setting offer presentation, but it went from everything having offer presentation to now only a number of homes in that position. So pretty drastic change overnight there. But it seems to have now filtered down into attached. So we're seeing multiple offers in condos and townhomes now where we weren't seeing them when attached was moving quickly.
So it seems that, this goes back to just the psychology of what's happening in the marketplace overall. There still is that demand for people wanting to get into their first home, their next home. Of course, there's investors trying to figure out where they can play into all of this. I think that historically the data would probably prove out that the shift from detached to attached is an affordability issue, because you're looking at entering the market on a detached at what, 800,000 plus for something like a 3-bedroom detached, for example. Is that number relatively accurate, or is it even higher than that in the Fraser?
It'd be higher. It would be higher than that. I mean, even to get, if you went as far out as Chilliwack, that's what I would consider to be the furthest city that the average lower mainland consumer would be considering. You're still 850 is going to get you a relatively old home. If you want to get into something that, I think the average person considers to be the home that they're looking for, you're looking at probably $1 million at least. Abbotsford, you're looking 1.1, 1.2, and the numbers just continue to rise from there. Langley, 1.4, 1.5 at least.
So then when you're looking at the attached at a townhome, for example, what kind of price points are you looking at? Because obviously if they're going to attached, if you're seeing the trend to attach, I think it's price driven because of the affordability of interest rates. So, the interest rate of 5.5 or 5% on a $1 million mortgage versus the, 5% interest on a $700,000 mortgage. I mean, that could be definitely enough to sway a buyer one way or the other. What's your thoughts on that? What are you feeling about it?
Completely agree. And, I think that the households that are looking at the attached are going to feel those increases a little bit more than a household that would naturally be looking at a detached home. Not to say that detached home buyers have unlimited amounts of money, but, I think $300 or difference makes a bigger difference in a condo buyer's world. So yeah, I mean, depending on which city you're starting, starting from Chilliwack to get into condo, you're roughly around that 300,000 price point, 350 for something decent. Abbotsford is looking probably 4.25. And then you're, low fives, Langley, Surrey, and it goes further as you head west. Townhomes, Chilliwack into something nice. You can get in there for the low sixes. Abbotsford's mid sevens, Langley's are pushing low eights, and so on and so forth. So definitely more affordable. I wouldn't call it, affordable in and of itself, but compared to detached, it's a more affordable option for sure.
So let's go back a little bit, because we look at it through the lens of a investor. And, I was just in a meeting today earlier that we were looking at a lot of different rent models in Ontario in this case. But, it was really apparent that regionality in terms of rents is quite dramatic and I'm saying that about Ontario right now. We saw rents down 2 or 3% in a couple of regions, where they're up 7 and 8% in other regions. What are you seeing from a rental perspective? If I'm an investor, am I looking at increasing rents? And we'll use Abbotsford, Chilliwack as an example, maybe even throw Mission and Langley in there.
Mhm.
But ultimately, what are we looking at, or what are you seeing for rents, or getting a feel overall in the Lower Mainland and Fraser Valley? What are you seeing?
So I've noticed recently that rents have picked up a little bit. I don't have an exact percentage number. I haven't tracked it long enough to give you that. But what I can say is anecdotally, we have been replacing some properties that were challenges to rent, only even 6 months ago. I'll give you an example of a basement suite one of my colleagues recently rented in Sardis in Chilliwack, 1 bedroom. She struggled to get $1,600 for it just under a year ago, and now this time she had a lineup of 20 people that she was able to choose from. Had it listed and rented within 48 hours. One of my clients has a detached home in Chilliwack, who the tenant there is open to taking a 20% rent increase, with the understanding that otherwise the homeowner will likely evict them. So I think that we're definitely seeing an increase here in the Fraser Valley, but we'll have to wait and see how that plays out long term.
Are you kind of connected to what's happening in that condo market in the Lower Mainland? Maybe, for example, Surrey. Let's use Surrey as a kind of a hub of what's going on there. How's that condo market in terms of potential cash flows, given where the rents are, given where prices are? What's the demand like?
Yeah, I mean, the demand is high. I've got actually a couple of listings coming up in that area, so I'm pretty fresh on what's going on as far as days on market, and they're dropping precipitously. Really challenging to find properties that cash flow. I mean, even like I say, you're getting into a 1 bedroom in the Guildford area that you can rent out for, say, $1,800, $1,900 a month. I mean, you're well into the that one we're looking 1 bedroom. I mean, you're well into the low fives on that.
Mm-hmm.
So at 1,800 income with property taxes, maintenance fee of call it $325 to $350, because those just keep going up very quickly. Insurance, all that, you're not going to be positive cash flow with 20% down. So the equation for cash flow becomes much more challenging as you head further west. I've always been a proponent of Abbotsford and Chilliwack because the income to purchase ratio has always been strongest out that way. But it's, if people are looking to purchase and invest here in the Fraser Valley or in BC in general, we kind of have to understand that cash flow is not going to be the number one goal in these properties without putting a substantial amount of money down. 20%, it just doesn't work. And, you might have to look at it as a long-term hold, with appreciation being more of the target for you on these ones.
Well, it's just interesting. JG Francoeur and I just did a segment on Rein It In, where we talked about, you have to, pick your poison, right? And so, in behind that narrative was really the discussion around where are interest rates going, and, how long will interest rates hang in there? And so we either buy today and invest and work hard to get that positive cash flow, or at least break even cash flow, and or maybe tie up a little bit more money to get that payment down, not as highly leveraged, and or even if you can afford it, some people can, depending on what they do, where they're taking and they can afford to take that $200-300 a month loss on cash flow. Now, having said all that, that's never the best strategy, but there is a strong argument that if you can ride it out for a couple of years, because here's what we generally see with interest rates, and Jordan, this, you've seen it over the years. Ultimately, what happens is Bank of Canada raises rates, which will in fact likely put us into at least some kind of a recession, or a soft recession, or a softer economic conditions, and then they generally overreact and or they fix the problem with these higher interest rates quicker, faster, which is what they've been doing. And then the economy slows down, and ultimately what they do is they then have to lower the rates. So that's all to say this is pick your poison. You sit on the sidelines watching appreciation grow, even if it's slow, and then chase the market, or you get in a little bit early, knowing that interest rates historically are just an influencer, and they will in fact likely come down in the next 18 months to 2 years or less. Now, having said that, We don't know. We can look at and say, well, let's just apply some common sense. And historically, we would see rates come down as the economy starts to slow down. The Bank of Canada reacts, does what they do. Now, given all that's happened the past 4 years, I don't think we can count on any of that. So whoever you are as an investor, you have to develop your thesis, but that would be one thing to consider is, again, we use the term, pick your poison, high interest rates today and or appreciation, and try and catch the wave in a couple of years. And so you have to kind of, as an investor, you have to look at it from a different perspective, perhaps. I don't know, any thoughts on that, Jordan, based on your experience?
Yeah, I agree. I mean, look, I'm always going to be having a focus on cash flow if I can find it. It's become more challenging. You have to look further west. You have to be looking at ways you can add equity into the home, add a secondary suite if you're looking for that additional income on it. Not everyone has the financial power to go and spend, $800,000-900,000 to get into a semi-detached where that is an option, and attached, it's very difficult. So, I've had this conversation with investors for a long time. I mean, you and I have had this conversation. You look at different locations within Canada, even where maybe cash flow is a little bit stronger, but the appreciation is next to nothing compared to here. And if you're running those two scenarios with a 10-year timeline, and obviously you're going to have to make some guesstimates on what's happening with these end numbers. I would still argue that you'd be better off further ahead purchasing here in the Fraser Valley, and maybe feeding it a little bit a month, same way you would put money into a bank account, and you would be further ahead as far as an equity position at the end of that decade. But you still have to make intelligent choices. You can't just buy any property here in the Fraser Valley and assume everything goes up, because that's just not how it works. To give you an example, we had, and this is maybe not the best example, but back in 2017, buying pre-sales was de rigueur. It was, what a lot of investors were doing. And then 2018 hit when a lot of those were coming up and the market was a lot slower. They weren't able to sell those off for the profit they were hoping for. Mm-hmm. My investors, though, they have a backup plan. They've always got a plan B, and they've held on to these properties. I've got a listing coming up in Willoughby for middle of July. They closed on it in 2018. They were not able to flip it out on a pre-sale. They kept it as a rental, even though it was negative cash flow. They fed it. It was about $150, $200 a month negative. Of course, that's increased over the years because the rents have come up. They're actually approaching neutral cash flow after only a few years with it. But now they're looking to sell off that property, and they're going to net out about $125,000 with an annualized return well into the 30%. Wow. So, it's maybe not the most ideal scenario, but it's not like you can't make money from it.
I think there's a couple things around this that we have to consider. Of course, you being a investor-focused realtor, and of course you deal with retail as well, but you understand how the numbers work and the deals that are happening. I know Eximus Realty, beyond just that hard asset called a detached or semi-detached or whatever, or attached. I mean, you have your eyes on all inventory that is available all the time. But I mean, you guys go also deeper in the investment realm of whether it be, raw land or construction opportunities, future, those things show up for you as well. Just all to say this: when we create a thesis of looking at what's going on economically in the world today, and Jordan, I know that you pay attention to what's going on even in the global macro, and we have the concerns that we have about monetary policy. We have the concerns that we have in terms of what's going on, Russia, China. Those get all really big, deep, and feels a little bit dark. But ultimately, what are we trying to do? We're trying to look at where we think the economy is going and actually have a thesis around how are we going to put our capital to work? How are we going to stay ahead of this inflationary period of time? And it's certainly not hyperinflationary, but it is a rapidly inflationary period of time. And as much as our government goes, well, no, it's not really so bad. No, it's bad. And so, tell that to somebody who's going to the store to buy food or who isn't getting a raise, and we can have all of those discussions. The point is this, is finding deals, and this is just my view, Jordan, I often say that if you're looking for gold, if you're looking for diamonds, you just don't walk down the beach and pick them up. You got to dig, you got to hunt, you got to do the work to find the deals. And I think that when I speak with an investor-focused realtor like yourself, that's how you view the world. You're going, yeah, they're not just falling, it's not low hanging fruit anymore. Cash flow is not low hanging fruit. You got to look and you got to dig deep. So I don't know where I'm going with that, but if you have an overarching thesis that we need to own a hard asset called real estate as part of our overarching financial portfolio, then you have to put in the time and look for deals. Anything you would add to that or correct in that thought process, Jordan?
No corrections, definitely an addition. I think that that deal that you're hunting for, you need to expand your scope a little bit if you're looking to have it at least in the near future, because it's becoming so much harder to find, because there are so many more people. I mean, the times I've been called and said, I'm looking for a deal. It's honestly a running joke at this point. I've never met a buyer that isn't looking for a deal. But they're not necessarily going to be that sexy basement entry, early 2000s, 5-bedroom, 3-bathroom home that cash flows $400 a month. It just, those are very, very hard to make work these days, if at all. Maybe now it's going to be something a little less impressive looking, maybe a little uglier. I sent out, so I do a hot property. If I find a property that I think is a good fit for investors, that I think cash flows well, is a great buy, I'll send it out to my network with a pro forma breaking it down. Last week, I sent out a little 1-bedroom condo in Agassiz, close to Harrison Hot Springs. It was listed for, what was it, $225,000. It's not pretty, but had new flooring. It rents out, or rent out for $1,400 a month. You have positive cash flow of like $300 a month, and then an internal rate of return of 10.4%. That's a solid investment. It's just not sexy.
Yeah, just not sexy. Well, it's always better when our real estate's boring. And I mean, I guess maybe a bonus would be if it's kind of sexy. But guess what? At the end of the day, what are we trying to do? Put our capital to work. And
I think making money sexy myself. I don't really care what vehicle I use.
What it looks like. So now, as we wind this kind of conversation down, Jordan, as an investor-focused realtor and who kind of does it all in the space, and especially with Eximus, with the brokerage and your team, and there's lots of opportunities out there. What are you kind of advising? Investors or retail, doesn't matter. What are you saying? Are you saying just basically be patient, make sure you have your financing in place? All those I guess all those rules still apply in this market. Anything that you would add to that? Just saying, what's your view? Would you add to that? What's the thing that you need to know?
Absolutely. I mean, you got to have your financial ducks in a row. You need to be able to act quickly because you're going up. Even if things are slowing down, you're going up against at least 3-4 other people, guaranteed. I think that that's very important. We talk about connecting with the team and all of that as well. But, being the squeaky wheel and being in constant communication, I have been not screaming, but low key yelling from the rooftops that this detached thing would only last for 6 to 8 weeks and then it would slow right down. But if you're looking to sell, this is a great opportunity to get premium dollars for your home. Same way I was saying, it will filter down into attached homes and those are going to start jumping up. So if you're looking to save some money, maybe you should be looking to buy attached today. I'm not the only one that was saying that. Looking and paying attention to these trends and calling these trends out is not overly difficult for someone that's in this world every single day. But unless you're in communication with me, I'm not going to be necessarily calling my entire client base and telling them all of these little intricate things. If you're very motivated and looking to make a deal, then be in contact with your team, with your agent, ask them what's going on. I don't mind fielding calls, texts on a daily basis from motivated buyers, because eventually that'll turn into a paycheck. So, I'm more than happy to do that. And I don't get a lot of buyers that do that, but the ones that do are the ones that have success because they're, yeah.
So, I mean, here's the point of it all is that we say time and time again, work with an investor-focused realtor who appreciates and understands investment. Lots of realtors don't. They don't even want anything to do with investors. So you have to kind of pick the person that you work with carefully, cautiously. That's why we have Jordan and from the Eximus team on these calls, because you're in it, you're looking at it through a different lens than most of the realtors who are not investor focused. And that's not to make anybody else wrong, just that's your niche, that's the game that you play. Jordan, we'll put it in the show notes as in the description below, but how do people get a hold of you?
So I can be reached by email, Jordan, Jordan, @eximus.com. Number is 604-996-3688. I'm much faster by text, but if you ever got questions, I'm always available.
What was your phone number one more time?
604-996-3688.
Reach out, text Jordan if you're needing some support, looking to invest in the Fraser Valley, Lower Mainland, as far east as Chilliwack. Love Chilliwack, by the way. So, Jordan, as always, thanks for your time. Thanks for your expertise and your insights.
Thanks, Patrick. Appreciate it.